Hello, it's Tim Moffat here, Portfolio Manager for the 18.6 Strategic Investment Portfolio. I'm here with Akhil Patel again for a bit of an end of quarter rundown and I guess discussion around what's happening in the world and the markets. We're just at the very, very start of April now, having closed out the first quarter of the year. The strategic portfolio was up, finished the quarter plus 3.9%. And that was against a broadly weaker global market. The MSCI World Index was down 3.7 and the All Ords was down 3.7. So roughly a 6% outperformance. Obviously, a lot happening in the markets in the quarter, and certainly inside of the portfolio as well. There's been a lot of change in the last 3 months. So we can perhaps come back to that. In terms of the best performers that drove some of our outperformance, top performers, unsurprisingly, was Global Energy ETF Fuel. That was up a bit over 25% in the quarter, or from when we entered the position. Also, we've got on a similar thematic is the Global Agriculture ETF Food, was up about 17%. And both of those pretty clearly tailwinds coming out of the situation in the Middle East. Interestingly, we entered those positions before that kind of became apparent, but pretty clearly, I think the market knew something was afoot there. Those stocks were starting to break out well before there was boots on the ground or action, I suppose, in Iran. We also had some good performance from a position in Rio Tinto, listed in Australia, and one of the other performers was some short US market that we added to throughout the period as the market in the US started to deteriorate. So, I mean, looking underneath the market and things, there's clearly been a rotation. Some of the leaders out of the major market lows in the US have certainly lost momentum against everything else. I mean, specifically, I guess I'm mentioning US tech. Some of those big names, the Mag 7, are looking materially weaker. So certainly a bit of a red flag we're keeping abreast of. One of the other major, I guess, catalysts or talking points is the inflation situation, which is starting to rear its head pretty obviously even before this Iran conflict, which is going to have so much more flow through to the cost of essentially everything due to fuel and fertilizer and just more difficult global trade. So, I think inflation is part of the reason that the fuel position and the food position have been performing so strongly. I think that's, and even bond yields, really, it's putting pressure on global bond yields. Basically, all of the global market, developed market bond yields are breaking out to the upside. So I think, it looks like this year, that's the place to be watching really, really closely, the inflation situation, which is a little bit of a, somewhat of a hard thing to gauge, given we don't really know exactly the roadmap here in the Middle East. It's very confused of lots of talk and lots of rhetoric. And I guess from our perspective in portfolio management, there's just a lot of cross currents at the moment. So what we've been doing inside the portfolio, huge changes in terms of capital invested between the end of December and the end of March. The portfolio's got over 50% cash in there now, and certainly there's been a rotation out of all of us, out of our cyclical positions and profit taking during the quarter, and basically just a little bit of hard hats on and bunkering down while this market, or as this market's been deteriorating. So I guess that's the way I'm seeing things from portfolio perspective. Akhil, how are you seeing it in regards to, I guess, from a real estate cycle perspective and expectations versus what we're seeing in the last 4, 6, 8 weeks?
Yeah, thanks a lot, Tim. It's been quite an interesting quarter. It's been interesting from the point of view of the decisions we've had to take in relation to our positions in the portfolio. And it's been very interesting, obviously, from a news point of view, and I use interesting in quotation marks. The reality is that if this conflict weren't happening, but you were to list out all of the things that you might expect at the end of the cycle, you would be pointing to inflation, you'd be pointing to, and I'm talking on a relative basis, I'm not talking absolute numbers, you'd be pointing to rising yields, you'd be pointing to central banks being caught between the hard kind of stools of trying to manage inflation, but also stimulate the economies, which for some reason are slowing down. You'd be looking at commodity prices going up. You'd be looking at stock markets overall going up, but having, significant periods of drawdown as, some investors start to get worried about very stretched valuations. You'd be seeing a rotation from kind of highly cyclical stocks into more defensive ones. And you would be seeing signs of euphoria in the real estate markets, things like really tall buildings under construction, but you also be seeing slowdowns in kind of central markets, so kind of the top tier cities, center parts of cities which have seen the most growth maybe a few years ago, but which are not really growing now, in some cases even falling, and probably most of the action concentrated in more peripheral or second tier, third tier cities. And I think we have been seeing all of that. And as you said, the market had been pricing in a lot of the issues in relation to kind of the Iran conflict before it happened. Now, some of it was in response to what was going on, but some of it was actually just where we are in the cycle. So in many ways, the conflict has taken place on top of all of the late stage cycle dynamics you'd expect to see, and in some ways has made them worse. Of course, particularly in relation to inflation and in relation to the kind of spike in energy prices, and who knows, or maybe it's something we can discuss, well, who knows where it will end up over the next quarter. But it's very much taking place against the backdrop of a cycle that is very much maturing. Where we are now is we are in a topping process. There's never any one day when the cycle peaks and then falls. There's a process whereby a lot of the action is as I've described, but then you've got to see what politicians, policymakers, central bankers do in response to various things, and that can sometimes boost asset markets for a little bit of time, delay the start of a recession potentially. Maybe the cost of that is supporting further inflation. Maybe they'll try to tighten things. Maybe they might bring the recession forward. It can vary cycle to cycle, and I think the kind of key thing for us is to be very flexible in terms of how we approach positions in our portfolio, because it's by no means kind of following one particular track at this point in the cycle.
Yeah, I think that's a really good summary. I mean, I think the last time we had one of these meetings, I think I said we were walking a bit of a tightrope between being cognizant that the market could keep going up, and you can certainly paint a very bullish picture still yet, as you've got the US heading into the midterms, and looks like there's going to be a fair bit of political pressure, I suppose, on the Republicans right now, given that the war is seen quite unfavourably. So maybe they could fire off a whole heap of stimulus that might be the catalyst for another surge. But it's also very, very easily you can paint quite a bearish picture as well, given what's happening with energy, in particular in Australia, with supply issues and inflation. Interest rates here are going up ahead of everywhere else in the world, or higher than everywhere else in the world. So you can also paint quite a bearish picture. And I think what we're trying to do is stay on we don't want to be fully out of the market. There's risks in that. We don't want to be fully in the market, given where we are in the cycle. There's risk in that. So it's just about managing the exposure, I guess, with the market to a certain extent. We'll still invest in things opportunistically, but we're not, we're certainly not going to just be fully invested right now against the tide. That's probably
I think the important thing to say is it's not a particularly bullish picture if you kind of know your cycle, and obviously if you're paying attention to the news. But we all know from our experience of being in the markets that markets can go up. I mean, obviously you have the commodity story, which very much is a war-related story. But also, the stock market, there is a rotation into more defensive sectors in the US, and to a certain extent in other markets as well. And that might, push the overall broader index up for a bit longer, and maybe you do get maybe a surprisingly quick end to the hostilities. And I think you're right. There is a lot of considerable domestic pressure on the US administration to start to wrap things up. And maybe this is wishful thinking, but you've started to see Donald Trump declare victory of various sorts. Now, of course, what victory means is completely undefined, but that's in some ways quite convenient and quite good for us, because maybe they have a bit of a conversation and they say, all right, this is all sorted out now, we can stop fighting, and it sort of settles down. And then I think there would be quite a euphoria kind of rally, or relief rally rather, not euphoria, and markets could go up. Now, I wouldn't say that is elongating the cycle at all. It's just there is when you've had such a strong run, there's quite a lot of momentum, there's a lot of people invested, a lot of people oriented towards the market continuing to go up, and that creates a certain momentum of its own. I think if you have the understanding of the cycle that we do, we know that these things are going to be time limited. You've got to be watching for particular changes and being necessarily having a relatively cautious approach to the markets.
Fantastic. I think that's a great little summary and snapshot of where we are. We also did put out a call for questions, which we got a whole lot of big list of questions, which have been fantastic. So in the interest of time, we're not going to deal with those today, but what we will do is do a follow-up, proper Q&A, go through all those questions one by one, and hopefully give appropriate answers for everyone that was asking those, and a bit more information. So look, obviously, if you're an investor or looking to invest more, or you're interested and want some more information, you can contact us on our website, or just email admin@oakleighfs.com asking for someone to contact you, and we'll have the appropriate person reach out. Thanks very much, Akil. I'll speak to you soon.
Thank you.
Bye.